While you were sleeping, $4 trillion in wealth just vanished from the precious metals market. Silver was trading at $120 on Thursday. By Monday morning, it was struggling to stay above $75. But here's the kicker. While Western bag holders were getting liquidated in absolute panic, China was laughing all the way to the vault. I'm going to show you the smoking gun data that proves this wasn't a market crash. This was an engineered extraction, and what I'm about to reveal will change how you see the entire precious metals game forever. Look at this chart right here. In just 30 hours, silver experienced its most violent reversal since 1980. We're talking about a metal that went from $121.65 per ounce to fighting for survival at $75. That's a brutal 40% collapse in less than 2 trading days. So why did this happen? Because the CME Group, the entity that controls the futures market, hiked margin requirements twice in one single week. And when did they do this? Exactly when the Kevin Warsh Federal Reserve nomination hit the newswires on January 30th. This wasn't coincidence. This was precision financial engineering. The paper market was specifically designed to break the back of this retail-driven rally, and it worked flawlessly. Over $4 trillion in total market capitalization across gold and silver was erased in one weekend. That's not a correction. That's a controlled demolition. But here's where it gets absolutely fascinating. Why is China laughing while Western traders are licking their wounds? Because Beijing has already moved to what I call the physical endgame, and they're playing a completely different game than you are. Let me break down the 3-part strategy that's unfolding right now. First, the export weapon. On January 1st, 2026, China didn't just adjust their silver export quotas. They replaced the entire quota system with a special government license requirement. What does this mean in plain English? It means Beijing can now turn off the tap of physical silver flowing to the West at will whenever they want, for whatever reason they choose. They've weaponized the supply chain. Second, look at the Shanghai Gold Exchange premium data that just came in within the last hour. While silver is trading at $91.45 in New York and London, the premium for physical silver in Shanghai is still holding significantly higher. The Chinese aren't selling their physical metal at these paper prices. They're laughing at the Western markets. Third, and this is the most devious part, the data strongly suggests that China is deliberately using the silver price volatility to shake out weak retail hands so they can consolidate physical gold reserves globally. They want the silver to gold ratio to remain volatile and unpredictable because fear keeps you paralyzed. While you're worried about your silver position, they're accumulating the world's gold supply at Depression-era prices. This is financial warfare disguised as market volatility. Now let's talk about the China leverage trap that's happening right now as I'm recording this. Reports from the Shanghai Gold Exchange in just the last 60 minutes show something absolutely critical. While Western retail traders are enthusiastically buying the dip at $90 per ounce, thinking they're getting a bargain, Chinese institutions are maintaining 20% margin requirements on silver positions. You know what that means? It means they've effectively created a firewall that prevents another retail-driven squeeze from happening. They learned from the GameStop saga, they learned from the first silver squeeze attempt. They're not going to let Western retail traders create another short squeeze that drives prices to $200 or beyond. The Chinese institutions have the discipline and the capital reserves to sit on their hands, while Westerners exhaust themselves buying every dip. It's a masterclass in patience and strategic positioning. Let's get into the technical catalyst that triggered this entire cascade. Kevin Warsh is viewed by the market as an extremely hawkish potential Federal Reserve chair. When his nomination was floated on January 30th, it triggered a massive short-covering rally in the US dollar. Why does a strong dollar matter for silver? Because precious metals are priced in dollars, and when the dollar surges, it creates immediate selling pressure on gold and silver. But here's what most analysts are missing. The timing was too perfect. The CME margin hikes happened in the same week as the Warsh news. The liquidation cascade began exactly when maximum leverage was in the system from the retail squeeze attempt. Someone knew this was coming, and they positioned accordingly. I'm not saying there's a conspiracy, but I am saying the pieces fit together too cleanly to be random chance. Now here's where the narrative gets really interesting because there's a massive paradox happening right now that nobody in the mainstream media is talking about. Despite this paper crash that wiped out $4 trillion in market cap, there is still a 200 million ounce physical deficit in silver for 2026. Let me repeat that because it's critical. The world is going to consume 200 million more ounces of physical silver this year than will be mined. Why? 2 words: artificial intelligence and solar energy. The AI boom requires massive amounts of silver for semiconductor production, server infrastructure, and advanced chip manufacturing. The solar energy transition, which is accelerating globally despite political headwinds, is one of the most silver-intensive technologies ever created. Each solar panel requires significant amounts of silver for conductivity. So we have a situation where the paper price is collapsing, retail traders are being liquidated and shaken out of positions, but the physical industrial demand is at all-time highs and growing. This is the definition of a disconnect between paper markets and physical reality. Now I'm going to tell you something controversial that might make you angry, but you need to hear it. China doesn't want silver at $200 per ounce yet. They don't want you to win this trade right now. Why? Because they want to control the industrial AI supply chain first, and silver is a critical component of that infrastructure. By orchestrating this price crash now, whether directly or by simply allowing Western market mechanisms to destroy the retail squeeze, they've accomplished multiple objectives simultaneously. They've wiped out the retail silver squeeze movement that was gaining dangerous momentum. They've transferred physical metal from weak Western hands into strong Eastern vaults. They've maintained affordable input costs for their domestic AI and technology manufacturing sectors. And they've demonstrated to the world that they control the physical supply, regardless of what paper prices do in New York or London. You think you're playing a game of financial chess, buying the dip and waiting for the squeeze, but Beijing is playing four-dimensional chess with the entire global currency reset and industrial supply chain. They're thinking in decades while Western traders are thinking in days. This brings us to the most important concept you need to understand: the growing divergence between paper silver and physical silver. COMEX silver, the futures contracts that determine the price you see on your screen, is increasingly disconnected from the actual physical metal that exists in vaults and can be delivered to your door. The Shanghai Gold Exchange premium proves this. The Chinese export restrictions prove this. The industrial deficit proves this. We're moving into a two-tiered market where paper prices are determined by leverage, margin requirements, and financial engineering, while physical prices are determined by actual supply, actual demand, and geopolitical control. If you own paper silver through ETFs or futures contracts, you own a promise. If China owns physical silver in their vaults, they own atoms. Promises can be broken. Atoms cannot be printed. So what does this mean for you right now, today, on February 4th, 2026? If you got liquidated in the cascade, I'm sorry, but you were over-leveraged in a manipulated market. If you're buying the dip at $90 thinking this is your second chance, understand that you're fighting against entities with deeper pockets, longer time horizons, and control over physical supply. The China strategy is clear: suppress paper prices, accumulate physical metal, control the industrial supply chain, and wait for the inevitable moment when the physical deficit becomes impossible to ignore. That moment might be 6 months away or 6 years away, but the mathematics of a 200 million ounce annual deficit guarantee it will arrive. The question is whether you have the capital reserves and the emotional discipline to survive the manipulation until then. Because make no mistake, this volatility is designed to shake you out. Let's zoom out and look at the bigger geopolitical picture, because this silver story is really just one chapter in a much larger book about the global financial reset. China has been systematically accumulating gold reserves for over a decade, often through undisclosed purchases that only appear in the data years later. They've been building an alternative to the SWIFT payment system. They've been stockpiling critical industrial materials from rare earth elements to silver to copper. They've been signing bilateral trade agreements with countries across Asia, Africa, and South America that bypass the US dollar entirely. The silver export controls that went into effect on January 1st are not an isolated policy decision. They're part of a coordinated strategy to control the resources that will power the next generation of technology and economic growth. Whoever controls the silver supply controls the AI supply chain. Whoever controls the AI supply chain controls the 21st century economy. Here's the final truth bomb that ties this all together. The $4 trillion that vaporized from the precious metals market didn't actually disappear. Wealth doesn't vanish, it transfers. That wealth moved from over-leveraged retail traders and momentum chasers into the accounts of institutional players who were positioned short, into the vaults of central banks and sovereign wealth funds who bought the physical dip, and into the strategic reserves of countries like China, who understand that he who holds the gold and silver makes the rules. You were told that the silver squeeze was a people's movement, a rebellion against the corrupt financial system, and maybe it started that way. But it ended as a transfer of wealth from the impatient to the patient, from the emotional to the strategic, from the West to the East. The bagholders that China is laughing at aren't just the people who bought silver at $120. They're anyone who thought that social media momentum could overcome decades of financial engineering and geopolitical strategy. This is the game. Now you know the rules. The question is, will you play smarter or will you be played again? The choice is yours, but the clock is ticking, and China isn't waiting for you to figure it out.